The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
You can focus on trade, you can focus on the Fed, or you can focus on AI. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. A totally different song I'm singing than I was at 9:30 this morning, because you take a look at the fade in this market. The S&P 500 now flat to maybe a little bit down. Remember, we were higher by about 1% just a couple of hours ago. A similar story when you take a look at big tech. Of course, Meta and Microsoft still higher on the day, and we've got some important reports after the bell, but the big tech index down slightly. The bond market not doing too much, not much of a haven bid underway for the long end. 10-year treasury yields pretty much flat. If you are looking for some risk appetite, Romaine, maybe you're finding it in Bitcoin, higher by just about 0.5% right now.
And we came in today with a lot of risk appetite. The red on your screen seems to be tied to some news out of Washington on pharmaceuticals, but big tech really sort of put a buffer under this market to start the day. Microsoft and Meta actually powered the market to fresh record highs intraday. The two companies spending hundreds of billions of dollars on AI, but investors, they don't really seem to mind, since that CapEx spend, we should point out, is actually coming from available cash rather than borrowing, and it's cash that for the first time in a long time is being heavily reinvested in the company's futures rather than just frittered away on buybacks and dividends.
Essentially, our view is you sort of stay with the AI theme. It's worked. Obviously, it's working this morning. It's going to continue to work. But owning some protection beneath is really wise, particularly when you think about it in the backdrop of how much these names have already outperformed.
Nevertheless, those two big tech names did provide a sense of euphoria on the markets, one that has been bubbling for some time, one that has unlocked the IPO market. CoreWeave set the tone with its wildly successful March IPO. That was followed by Mountain in May, stablecoin company Circle in June, and today, on the final day of July, its app development company Figma, storming through the gates, 40 times oversubscribed in an intraday high, more than triple its $33 offer price. We should point out that the number of non-SPAC IPOs in the U.S. is now firmly above pre-pandemic levels, and that's putting quite a bow in what has been a phenomenal month of July for stocks that included a 3% move in the Russell 2000 small caps, the NASDAQ 100 tech stocks, and the broad benchmark S&P, which notched 10 record highs prior to today over the course of the month.
Yeah, it has been quite a month. As you mentioned, it's the final trading day of July, so I thought we'd take a look at the dollar. The dollar has been one of the most interesting assets to track this year. That did not change in July because it actually notched its biggest gain as measured by the Bloomberg Dollar Index since December of last year. You can see we're coming off of 6 straight months of declines for the dollar index. That has been definitely a story that's percolated through all of the asset classes. But in July, actually notching a gain of 2.6% for the dollar index. The question, of course, Romaine, is whether or not this is sustainable.
Kara Murphy joins us right now to kick us off to the close, CIO over at Kestra Investment Management. And Kara, I will start off by stealing Katie's question about the sustainability and durability of what we're seeing out there.
Well, when we look back over the last 10 years, you're talking about the dollar. There's been this incredible strength in the dollar that's really underpinned a lot of U.S. assets. Then you get to the first half of this year where suddenly the dollar starts to turn down. Now, the decline in the dollar has not been massive when you compare, other big moves in the dollar over time. But I think it does signal somewhat of a shift in that for many years, the S&P 500 was the most dominant, best performing asset class. And suddenly owning things outside of the S&P 500 actually matter. Whether that's assets out, like stocks outside the U.S., whether that's bonds. And we're calling 2025 the year of diversification, where owning things outside the S&P 500 is certainly a positive for your portfolio.
I am curious, though. I mean, and I've heard a lot of talk about the diversification outside of U.S. assets, not necessarily abandoning U.S. assets, but just providing a little bit more of a buffer. Why don't you think, though, we're seeing more of that? Because when you look at the data, a lot of people are still crowded into those narrow U.S.-focused trades.
100%. And there's actually a really good fundamental story for U.S. assets, right? You were talking earlier about AI, productivity kind of filtering around the broader U.S. economy. U.S. economic growth has been really strong. So there are really strong, good fundamental underpinnings for like the U.S. large cap growth story. The question is how much of that is already priced into those stocks. We look at valuations. They're among the highest levels that we've seen in 25 years, much, much higher than some of our partners outside the U.S. And at some point, that growth story starts to narrow. And with that, the valuation differential starts to narrow between those two parts of the world.
Let's talk about valuations a little bit more, because heading into the tech earnings season, of course, as always has been the case for the past few seasons, there's this really close focus on AI spend, on CapEx. We heard from Microsoft and Meta still committed to those big figures. But when you overlay that with the valuations of some of these companies, I mean, how much do you need a return on investment here?
I think expectations are really high. I mean, if you look broadly at corporate earnings growth, Q1 to Q2, growth certainly slowed. And we saw that confirmed in Q2 GDP data that came out, I believe it was yesterday. Now, as we look through earnings season, we're, about a little over a third of the way through it. What you see are the number of companies that are beating are about in line with historical averages. But where we see profit margins increasing is largely concentrated within tech companies and communication services. And a lot of that is what you're suggesting with the AI story. So I think an important piece of the story is that those companies are able to continue delivering earnings at the same time that they're reinvesting for future growth. Now, as you suggested, they're going to have to prove those returns over time because expectations have gotten really high. But for the moment, they've convinced investors that the ability to get those returns are there.
Yeah, absolutely. Seems to be for the moment that is the case. We'll see how many more quarters that holds. But also one of the undercurrents of this earnings season is, of course, what's going on with trade policy, what's going on with tariffs. I think about it, Texas Instruments, I think it was last week or the week before, saying that they actually weren't certain how much of the strength that they saw in the previous quarter was due to a pull forward, people trying to get ahead of tariffs. I know that that's one of the questions going into Apple results tonight, Kara, and I wonder how you think about those two factors in connection with each other, the actual fundamental results that we're getting and the uncertainty of how tariffs are impacting those numbers.
So I think investors have accepted the fact that there was a lot of tariff noise in the second quarter. And again, we saw this very clearly through Q1 and Q2 GDP, where there was clearly a pull forward in demand. Consumers and companies were buying ahead of tariffs, raising inventories. And then Q2, that demand slowed as people worked down those inventories. And you gave a few examples of companies that are sort of living through that. So I think that noise can be accepted in the past as long as we have some stability going forward. And what the market has priced in right now is that, yes, there'll be tariffs ahead, but they're not going to be that negative for company earnings as a whole. Certainly, there are going to be individual companies. I know the automakers have really been in the crosshairs of sort of where they fall in this tariff question. But overall, when it comes to the market is pricing in right now that the administration is not willing to accept a recession in exchange for its tariff policy or any other policy. As long as that holds, I think the market can hang in, minus a few companies that have to like sort of dance around that. But with that, the sort of noise of tariffs recedes a bit into the background, which is a good thing.
Kara, always a pleasure. Kara Murphy, Chief Investment Officer at Kestra Investment Management, kicking us off to the close here on this Thursday afternoon with the eye on the IPOs today. We should point out one of the biggest one-day pops that we've seen so far this year. That was in Circle at the start of June. Looks like that's going to be eclipsed today by Figma. We're going to talk to Erica Brescia, Managing Director over at Redpoint Ventures, about her expectations for that company and the rest of the IPO pipeline.
And speaking of tech, we'll speak to Alger CEO Dan Chung, whose firm owns stock in all of the banged up 7 names, as Apple and Amazon results are due later this evening.
And with an eye on those Amazon results, we're going to talk about the company's retail segment. Remember that? Remember when it just used to be an e-commerce business?
Huh.
Well, apparently competition is heating up in that space. We're going to talk to Kearney partner Katherine Black. Stick with us. A lot more coming up here on The Close. This is Bloomberg.
Well, Figma shares absolutely soaring by more than 150% on their first day of trading, now trading at about $107 a share after pricing at $33. Now the design software company making its public debut under the ticker FIG. Here's what CEO Dylan Field told Bloomberg TV earlier today.
I think it's not just that Figma is going public today. Design is going public today. I think we're now in a world where design is the differentiator. That's been our thesis for 10 years. We've seen it play out, but it's even more clear now that design, craft, point of view, that's what sets companies apart.
Joining us now to discuss is Erica Brescia. She is managing director over at Redpoint Ventures. Her firm invests in tech and has backed companies with IPOs and M&As such as Snowflake, DraftKings, Netflix, and him and her. So an impressive resume there. Erica, I know that this was a hotly anticipated IPO, but with that being said, are you surprised by just the open arms exception that we're seeing today?
Honestly, it has exceeded even our expectations, I think, on how well this would go. It's fantastic to see. I mean, Figma is an incredible company, as everybody well knows by this point in time. And I think there was a lot of excitement and anticipation around what would happen today. It's even higher than I expected it to come out. And congrats to Dylan and the whole Figma team.
Yeah, I think a lot of folks are surprised by some of the numbers that we're seeing right now. And of course, the natural question that follows is, what does this mean for the other companies in the pipeline right now? That has been the question, when we're going to see a really robust return to maybe some more normal levels. We're starting to get there, but an IPO like this, Erica, I have to imagine that that helps some of these companies along.
I think it does. I mean, you've had companies like Databricks who have been waiting in the wings for a while, a fantastic business, also growing at, 50% year over year. I think they were at 3.7 billion in revenue run rate, and they are profitable. And as was Figma, you have some flexibility in terms of when you go out. And I think everybody's been waiting to see what would happen in the markets and how Circle and this IPO would be received. And obviously, seeing the very positive reception should have a positive impact on, the timing of future IPOs.
Yeah, and it's kind of interesting. I mean, you bring up profitability. I mean, there was a lot of talk when it became clear that they were going to become public, that this would be one of the few companies that actually did have profitability, including on a net income basis, and more importantly, still had a relatively healthy growth rate. And I am curious on the revenue side, and I am curious about that aspect of it, because everyone I spoke to seemed to really focus in on that idea that the analyst community modeling something like 30 to 40% growth for at least the next couple of years. And it's hard to find certainly any software company, and certainly not a mature one, that can actually compete at that same growth rate.
Yeah, I think Palantir is the only other public software company that's growing at that kind of a rate. As I mentioned, Databricks has been too. So I think, we're still seeing very, very healthy growth in these private companies that are preparing to go public. And I think as they come to market, we'll see that continue to be the case. These companies have been expertly navigated through the changing AI landscape thus far, and I certainly have very high confidence in their executive teams to be able to continue to do so.
When you look at the pipeline of potential IPOs, the ones that are in the private space, potentially going public, including maybe some of the ones that Redpoint has a stake in, what is the quality overall, Erica, of those companies?
I think it's exceptionally high, and that's part of the reason these companies have been able to remain private for as long as they have. You take Stripe, a Redpoint portfolio company, or Databricks, and they have had the luxury of access to capital in the private markets at fantastic terms, because they are running exceptionally good businesses. And so they have all the power about when they go out to market, and they're going to look to, the Figma IPO and any others to come to see how those are received by the market. And they're going to go out at their own pace when it makes sense for their business, because they really don't need to. Yeah,
that's the thing. And to that point, Erica, I wonder if it's your opinion that something fundamental has changed in the way that companies fund themselves. I mean, a Stripe doesn't necessarily have to go public. To your point, you think about a SpaceX, which I know isn't a portfolio company of yours. That's another company that can get all the funding it needs pretty much in the private markets. Do you think that we have entered a new regime where some of these companies are just going to stay private forever?
Forever is a very long period of time. I don't have that kind of a crystal ball. I wish I did. But I think they will remain private for longer and longer. And again, they're going to go public at a time that it makes sense for their business. It could be to make a strategic statement to the market. It certainly is a huge win for employees and has a material impact on morale. It can improve access to, the capital markets. Obviously, it gives them more options. And so, I think that there are still very good reasons to IPO, and we'll see companies do that at a point that it makes sense for them. I think anything that can be done to smooth the way for that to happen, we do have a pretty intense regulatory environment, and seeing some of those restrictions relaxed potentially, and the cost of going public come down could have an impact as well on some of these businesses and their choice to do so.
Erica, really appreciate you taking time for us. Erica, and hopefully we can talk to you soon when some of your portfolio companies hit the tape. Erica Brescia is Managing Director over at Redpoint Ventures. A closer look at Figma. And Katie, this is pretty phenomenal. We're talking about an IPO at $33 last night, open today at 85 bucks, intraday high of 116. And I was just going through the data on the terminal. If it holds these gains, biggest first day pop for an IPO this year, for a major IPO this year.
It's just amazing. And if I were to put on my Matt Miller hat, which I don't do that often.
Yeah, that's like a trucker hat.
He would be pounding the table right now about how the bankers left money on the table, but I'll let other people.
Can I just say, I know our viewers don't know this, we'll go behind the fourth wall, but sort of right behind these cameras is where my desk sits. So I get to hear Matt Miller pounding the table all the time about money being left on the table. You know what?
Yeah.
Dylan Field's making out pretty good. And you know what? He has an equity stake, so a 200-something% pop in the stock.
Yeah, these are really champagne problems that we're talking about here.
First world problems here. Well, speaking of which here, we talk about hot IPOs. Coinbase, which believe it or not was actually one of the worst performing IPOs during its 2021 class, has really perked up over the last 4 months, more than doubling in price, and they're set to report earnings after the bell tonight. We're going to discuss what to expect when we come back. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Novo Nordisk, the maker of the weight loss drug Wegovy. HSBC, which reiterated its buy rating on the stock just 3 months ago, says it got it wrong, citing recent execution hiccups and abrupt management changes, downgrading to hold, slashing the price target by more than 40%. Those shares down 3% as it continues to slide back down to its lowest since 2022. Next up, eBay. BMO upgrading the online auction company to outperform, raising the price target to a street high 102 from 70 bucks. This following the company's second quarter results. The analyst cites accelerating growth and new opportunities in advertising, eBay at a record high. And finally, CoreWeave. Citigroup closing its negative catalyst watch on the cloud software stock and upgrading to buy with a 160 price target. The analyst says Microsoft's earnings yesterday gave him a stronger view that the AI demand ramp up for CoreWeave will continue. Those shares up 13% on the day. All right, we're also keeping an eye on Coinbase. Those shares fractionally higher on the day as the crypto platform prepares to report results after the bell. Devin Ryan joins us right now, Director of Financial Technology Research over at Citizens JMP. I believe the consensus estimate on the street is something like 10 to 11% growth in revenue. Is that what you're expecting, Devin?
We are, Romain. We're expecting, a good quarter year over year. I think trading volumes were down a little bit from the first quarter, but it's also going to be really noisy because you have that data breach charge, which you remember a couple months ago they had a data breach, and so that'll roll through results. And then on top of that, they're going to have a really nice gain related to their stake in Circle, which just came public in an IPO. So I think there's going to be a lot of noise in the actual headline result, but expecting, I think, a pretty good quarter. And then more importantly, everybody's going to be paying attention to what they say about the outlook for stable coins and tokenization and all the enthusiasm we're seeing in the market right now.
Yeah, and before we talk about that, I am curious about just trading activity overall. I mean, we heard from the big Wall Street banks, they really benefited from some of the market volatility out there when it comes to public equities and public debt. Did that volatility also provide a benefit for crypto platforms like Coinbase?
You would think that there might have been with the volatility that you just talked about, but there wasn't as much in the second quarter. And some of that was because you had such a surge in activity after the election, and that carried into the beginning of the year, kind of the first quarter, just on enthusiasm that we'd finally get kind of rules of the road. And then the second quarter was a little bit quieter, just around kind of new information coming to the market. And so I would actually say there was less activity. And so you'll see a decline in the second quarter. But interestingly, now that we had the Genius Act just recently signed, the data we're tracking is that July volumes for Coinbase are up around 30%, or actually even a little bit more than that. So I think you're going to hear about a little bit of a slower second quarter, and then third quarter thus far is tracking really nicely. And I think that sets the tone into the back half of the year, which is, again, what we're kind of focusing on.
Well, as we await these earnings, I do want to point out that Coinbase shares are up about 53% in 2025. But I see this line in your notes you wrote, actually, we continue to believe that Coinbase is misunderstood in the market. Obviously, shareholders seem to like it. Where do you see the disconnect?
Yeah, so we've been talking about this from really the beginning of when the company came public, that this company is much more than a place to buy and sell cryptocurrencies. Of course, they're the biggest platform in the US, but really they're building an ecosystem where firms that want to get access to using blockchain technology, whether that's stable coins or tokenizing all other types of assets and trading those assets, Coinbase is going to have their hand in that. They're going to be involved in payments and Web3. And so all these other iterations of how blockchain is used, Coinbase will have a connection to that. And that part of the business, subscription and services, is already roughly a third of revenues. It was virtually nothing 5 years ago. But I see that growing a lot faster than the exchange functionality. And so, the stock has done well, but these other pieces, like the connection to stable coins and payments and tokenization, we're literally in the first inning of that. And I think that's really the story from here. And that's, if you're going to buy the stock here, you want to get excited about that. But I think there's really big upside related to those themes.
So you're making the point, of course, this isn't just a crypto exchange. It's more than just buying and selling different coins and tokens here. What does the competitive landscape look like right now? Who are Coinbase's biggest competitors at this point, and how do they stack up?
Yeah, it's a great question, because ultimately what's going to happen here is you're going to see convergence of kind of your traditional crypto-based companies, the exchanges, and firms that are building technology in that landscape, and then traditional financial services companies, exchanges, investment banks, traditional banks, and it's all converging. And the reason that's happening is because we're finally getting regulatory clarity. And that's actually, as I just made the case, I think a really good thing for Coinbase. So they're going to benefit from virtually all facets of crypto getting adopted. And so on one hand, volumes will grow, and I think that'll benefit them. On the other hand, spreads will compress as more competitors enter the market. And we're very comfortable with that, because as you've seen over time, in financial services, as volumes grow, the leaders, and Coinbase has a pretty big competitive advantage in their technical expertise in a really technical industry. The leaders continue to take market share. And so that's ultimately what we think will happen here. And so more adoption, even with more competition, will be a boost for them.
All right, Devin, really appreciate the time and the preview. That is Devin Ryan. He is Director of Financial Technology Research over at Citizens JMP. And coming up moments away from Amazon and Apple earnings, we'll speak with Alger CEO Dan Chung about what to expect.
3:30 p.m. in a rainy New York City. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. And it's going to be hard to transition back into the market, but we should talk a little bit about the state of emergency in New York City right now. Apparently, pretty massive flooding expected.
Yeah, and we should point out, in all seriousness, the New York governor has declared a state of emergency. It's just started raining here, but there's a lot of expectations for heavy rains, flash flooding. Several of the train lines have already been suspended so far. And Katie, I believe you live somewhere that requires river transit. Are you going to be able to get home?
Yeah, I hope so. I'm definitely driving. I live in Hoboken, so we'll see. You're going uptown, so you're headed to higher ground. So we'll
that's why you bought the house up there, top of the hill.
There you go. I'm ditching right at 410 though, so I hope that your commute home at 5 p.m. looks a lot better. If you're still watching on a television, maybe you should actually just pack up and go home right now. But after this conversation, because joining us live in studio, I'm thrilled to say we have Alger CEO Dan Chung. His firm owns the Mag 7 across its suite of growth-focused funds. First off, great to see you in person.
Thank you, Katie.
So let's start with a look back. I want to talk about Meta and Microsoft, because kind of the overarching question over the past couple of earnings seasons is, how much investor patience there is when it comes to CapEx, when it comes to seeing that ROI, and when does that patience actually run out? Given that you hold these names, I wonder how you're thinking about some of these big CapEx numbers that these companies are putting up.
Right. So I think it's still very early stages in AI. These are two of the biggest and best leaders in that space and have multiple ways to leverage it for a long, long time, years to come. Today's earnings were confirmation of, yes, the spending will continue, but Meta's numbers in particular, Meta is one of the biggest users of AI across all of its advertising tools, and the results were spectacular. I mean, it's a $200 billion revenue company going 20% plus with better margins, even as they're spending all of what they are for Llama and AI. So it's a great example of the things to come and early days yet.
Are you, on Meta, are you surprised by the resurgence that we've seen in this company, and for that matter, the stock? Because I felt like a couple of years ago, everybody was sort of poo-pooing them because of the bet on the metaverse, and prior to that, they had the Cambridge Analytica and all those scandals, and this was a stock that everyone had just kind of pushed to the side.
Yeah, it's amazing.
Yeah.
It was kind of widely hated, and has gone to being right on the money in a lot of its internal AI bets for driving advertising, but also, I mean, people are saying that Llama 4 is behind the others, but Mark Zuckerberg obviously is going heavy duty after AI experts across. I mean, he's paying Tom Brady packages to engineers.
I'm thinking about applying there.
It's pretty.
And I know nothing about AI.
Yeah, maybe they'll find something, but it is just amazing looking at those pay packages. And just to stick on Meta for a little bit longer, I mean, I think about the year of efficiency all the time after they burned so much cash on the metaverse that they had to do a complete reset after 2022 and really tighten the belt. What distinguishes, in your mind, the metaverse from AI? Is it just that it seems like all of the Magnificent Seven is chasing the same puck?
Well, it's funny because as the metaverse goes, that's kind of faded.
Yeah.
And they focused basically on the core of their business, which is just advertising, social media. Although I will note the Meta Ray-Ban glasses, that franchise, I think the growth rate tripled there. So maybe that'll be the first big hit as a wearable. But basically, it did refocus on costs, but the best thing for a growth investor is they didn't do that exclusively. They also recognized the next big opportunity. So it wasn't the metaverse, but it is AI. It's AI driving their advertising, and AI driving, the goal for, super intelligence.
We just flashed some of your big holdings there. You've obviously had some huge winners, obviously Meta, Microsoft, NVIDIA. Two on there, Amazon, which I do want to talk about, but I do want to get your thoughts on Apple, which has been a bit of a laggard. And the criticism seems to be that investors just don't know what the longer term strategy is, what the AI strategy is, what the innovation strategy is. Do you have those same concerns?
So we do have concerns about Apple. I mean, this was once our top holding, and we are underweight it relative to the benchmark. But Apple, of course, is a very high quality company, has great position as a as the iPhone and the iPad and in the device universe to be an AI enabler for millions and billions of consumers. But it is behind in that race, and it is losing talent in that race. And right now, they're sort of in a bit of a lull that they don't have a particularly interesting product cycle ahead of them. So I'm definitely not counting them out. But as I said, we've gone from significant overweight top holding to underweight, a very big and good company, but nevertheless, trying to find its way.
You think about some of the cross currents coming at Apple. Of course, you have the AI narrative that they're an also ran in that category. You have what's going on with tariffs, what their supply chain looks like. It just feels like sentiment is so sour on this stock. What would you need to see that would boost your holdings in this company?
I think we would need to see, first of all, an exciting product cycle. And that really is going to have to come with Siri becoming, the first AI chatbot that everybody has on their mobile phone. That would be the really thrilling thing. But we'd like to see just some improvement in Siri. And Siri is lagging badly.
Yeah.
Somebody who uses it a lot, regrettably. I'm always actually kind of shocked, too, because to a certain extent, they were kind of a first mover in that space and kind of lagged. Before we let you go, I do have to get your thoughts on Amazon. They're also reporting after the bell. And I never really know how to characterize Amazon anymore. I mean, I know we kind of call it an e-commerce company, but that kind of shortchanges what this company really is.
Yeah, that's a great insight to it, because Amazon, we all need to focus on is the cloud services. AWS is with Azure. Those are the two biggest cloud services. And Microsoft's results in Azure cloud services was tremendous, acceleration on a huge base. AWS is even bigger and isn't growing quite as fast, but it is growing at a very fast rate for something so large. And it's hugely significant to Amazon's today and their future. But meanwhile, they also combine, they're a great example of a company that is both driving AI, but also as an adopter, because they have such a brick and mortars intensive, people intensive, product intensive business. As they use that to improve their efficiency, we see lots of productivity gains for them that could be tremendous.
All right, Dan, great to have you here in studio. That's the CEO of Alger, Dan Chung there. A nice preview of two big tech stocks that are going to report earnings after the bell. That includes Amazon, up about 1% here in the cash session, and Apple down about 0.2%. Full coverage on the close after the bell on both of those names. Meanwhile, we take a look at some of the earnings that crossed the wire earlier today, and that includes Norwegian Cruise Lines. That stock's sailing higher, buoyed by record bookings. You love the puns, Katie Greifeld?
Oh, boy.
We got them all here on the close. This is Bloomberg. All right, let's take a look at shares of Norwegian Cruise Lines. It is our stock of the hour. The shares at one point hitting their highest level since February, now up 9% after the company says it's seen a rebound in bookings. Lizzie Dove joins us right now, U.S. leisure analyst in global investment research over at Goldman Sachs. And I do want to go back 3 or 4 months ago when the CEO came out and talked about some concern, about uncertainty, about choppiness in the market. And then he comes out today and basically says, hey, everything's great across all 3 of our major brands. You seeing the same trends, Lizzie?
Yeah, it's honestly incredible. I think, the choppiness in April is well understood, and there were clearly a lot of reasons for that. I will say that the challenges that Norwegian was seeing were more acute on the European side, which is more of that long haul, slightly higher end side of things. But now what they've seen as the macro has become a little bit less choppy, more of a higher consumer confidence, now things have rebounded, and July was a record month for Norwegian. So clearly things have turned around very nicely for them.
When you look at the guidance that they gave, particularly for the current quarter, $1.14 a share on the bottom line, which was actually a little bit lower than the average of analyst estimates. Is this one of those cases where it's kind of under promise, over deliver, or are you taking that 114 seriously?
I've taken the 114 seriously. And what I will say is that when you look at what they reported for EPS today, there was an 8 cents FX headwind. And so that was kind of impacting things a little bit. When you look at the go forward, though, actually things are on a really, really nice trajectory. And that's not for 2025, but that's for 2026, too. And I think that's what's key, and maybe some investors are missing, is the exit rate for 4Q is very, very strong. And with the bookings now at record levels, that's not about today. Those bookings are for tomorrow. And so really what it really paints the picture of is a very nice long-term runway.
Well, Lizzie, talking about those record bookings that we saw in July, what sticks out to me is that we heard Summer say on the call that the rebound was primarily from improved economic conditions, that it wasn't necessarily utilizing unusual promotions to boost and juice demand there. So that's not even a lever that they've pulled here.
Right. And I think that's what matters. And again, another thing that sometimes investors miss that is really, really key about cruise, and that is it is a great value proposition. It is still 20 to 25% cheaper to go on a cruise than it is to go on an equivalent land-based vacation. And so even in a choppier macro, consumers still want to take a vacation. And so even if they're choosier around how they spend their dollars, cruise is a great option because of that price gap. And that's without discounting, to your point.
I want to bring this conversation to what's been happening in the stock market, because you take a look at Norwegian shares with this boost that we're seeing today. They've just about erased year-to-date losses, but as you can see on the screen, still negative for the year. You compare that to Royal Caribbean, up double digits. Same thing, too, when you see Carnival. How does Norwegian actually close that gap? Do you see that as a possibility?
It's a great point. And I think today goes a long way in starting to close that gap, because what it gives is credibility. And that's credibility that there wasn't an issue on the brand side of things with Norwegian, that they aren't a shared donor, which was a fear that investors had. But actually, things are on a very nice trajectory. Now, that being said, there is a key difference between Norwegian and Royal, and that is leverage. I mean, Norwegian is still over 5 turns levered. If you compare that to Royal, they're, investment grade, they're buying back stock, they have a dividend. So there's a reason for that multiple gap. But now with the credibility that Norwegian has and that long-term runway I mentioned, I think it can start to narrow.
And just Phil, finally, Lizzie, I am curious just overall about this strategy that the cruise lines have started to take with regards to building their own facilities, islands and other things off of the boat here. You see that as a viable strategy?
I think it's a great strategy. In fact, the private islands that the cruises already have launched, and there's more coming, as you say, they have the highest customer ratings out of any port across the globe. People love it. And I think part of it is the amenities that they have. It's water parks, it's beach bars, there's everything that you could want. And it's right when you step off that ship. And so it speaks to the convenience, and it speaks to the fact that the customer demographic is getting younger. There's families, and it appeals to everybody. So I think with more of those islands coming online over the next few years, that's another piece of the puzzle that helps cruise accelerate from here.
All right, Lizzie, got to leave it there. Really appreciate your time. That is Lizzie Dove. She is U.S. leisure analyst in global investment research over at Goldman Sachs.
When was the last time you were on a cruise?
Never.
Yeah,
have never been on a cruise.
Yeah, I've never had the, I don't know, is it a pleasure, a privilege?
It doesn't surprise me
pain?
that you're not
know.
a cruise person. And
Yeah, I don't like to be confined,
Yeah, I fear the ocean.
I don't know. It's just like you're just out there.
Yeah,
and that's it.
No, I like to look at land, and I like to think about the closing bell as well. And that's what we're going to do up next with Sherry Paul, Managing Director and Private Wealth Advisor over at Morgan Stanley Private Wealth Management. She's here for the closing bell. Don't go anywhere. This is The Close on Bloomberg.
10 minutes until we get to the closing bell. Romaine Bostic here alongside Katie Greifeld. We started the day. It looked like we were going to have a pretty sizable rally on our hands. The updraft that we were getting from Microsoft and Meta, but of course, some talk out of Washington took the market down, as has happened frequently.
Absolutely, a big hit to sentiment there, and you can see that reflected in the indexes right now. The S&P 500, we were higher by 1% earlier in the session. It looks like we're going to close out the month of July with losses right now. Losses coming from the tech sector with the NASDAQ 100. You have Microsoft and Meta hanging in there, but the rest of the sector not cooperating, not sending much of a haven bid into the bond market. You can see the 10-year Treasury yields down a little bit, but even Bitcoin is lower on the day.
Even
that
Bitcoin.
is your measure of risk appetite. Yeah, what are we going to do?
All right. Well, we should point out, too, you point out the tech stocks. Microsoft still up about 4% at that $4 trillion market cap, a record high. Meta up more than 10% on the day to yet another record high. And after the bell, we're going to get earnings out of Amazon and Apple. And of course, everyone wants to know what the AI story is for all of these companies. Sherry Paul joins us right now to help us count you down to the closing bells. Private Wealth Advisor and Managing Director at Morgan Stanley Private Wealth Management. All right, Sherry. The AI story has been the story for the last couple of years. It has also probably been one of the most criticized of the thematic trades out there. I don't know if yesterday with Meta and Microsoft ends up being that true inflection point. But when you look at the amount of money that they're spending, their commitment to continue spending that, and the idea that they're articulating an actual return on that spend, does that sort of mean that the critics maybe had it wrong?
Yeah, look, I think it's earnings the day that will live in infamy, that this is the moment that the skeptics have the information that they want, which is verifiable earnings. You know, for those of us that have been talking about this for several years, to your point, we were looking at it from an opportunistic innovation trade set within a once-in-a-generation lifetime industrial bull market, which by definition means that the entire world economy is about to reorder based on this technology, which is very different than what happened with the internet, because this is actually a tech that can be downloaded and installed in verified businesses that actually produce earnings to create earnings expansion and potentially, at a corporation's discretion, take away the most expensive cost, which is human labor. So this is a pivotal moment in our opinion, and we've been investing in the theme and will continue to do so. And
I've heard a lot of lofty predictions kind of comparing this to the Industrial Revolution or the advent of actual computer technologies in the 40s, 50s, and 60s, whether it lives up to that. I do want to draw an analogy to the dot-com boom, because when we all knew the internet, or most of us knew the internet was going to turn into something, but there was a lot of difficulty in picking who the winners were going to be. And most of us probably picked the companies that don't exist anymore, and we ignored the ones that are still standing today. How do you value AI going forward? Yeah. Because it's so much money being spent, and you look at the multiples on some of these stocks, and to me, they just seem ridiculous. Yeah. And so how do you sort of look at those multiples and say to yourself with confidence, don't worry, over time, this will make sense?
Well, look, I love drawing the comparison because I had a front row seat to the internet, and you're right that I think that there was the infrastructure build out, not really sure what it was going to do and what it was for. It was a research tool in the beginning, and then it was, how is this going to turn into commerce beyond just social? We've gone through 3 different iterations, and then the pandemic hit, and that was really when, in our view, that the remote of everything came into play. I mean, at that time, I think it was less than 20% of Americans had ever remote deposited a check. Now we're doing high stakes transactions, and we're trusting the tech more in the most intimate parts of the decisions that we're making. And so if you fast forward, we're at a moment, I really believe, where we're going from candlesticks to light bulbs. Wow. We're going from horse carriages to cars. And what's different about this is that I have a client who's building a house, and this is where individual clients, and remember, I'm a private wealth advisor, so I work with individual families that want to know, like, what are we going to do now? My responsibility is to find the corridor of investing opportunity in all market climates, not to wait it out. Right. Because waiting it out is not a strategy. And so the way that I'm explaining this to them, because it's hard, is, listen, if the invention of the hammer, they're renovating a house. Oh, this is amazing. I can hammer a nail and put 2 pieces of wood together. Well, now the hammer can do that on its own. Okay, and superintelligence says, wow, not only can the hammer do it on its own, the hammer at some point could look at the nail, the 2 pieces of wood, and go, ooh, I think I'm supposed to nail that thing together, without an instruction. Yeah. And that's does that make sense? I mean, that's the simplest way. No, it does.
I mean, it sounds
You've got Katie's attention here. She's wrapped.
Yeah. I'm a little scared. I mean, it's a little dystopian to think about.
And this is what all people and investors are experiencing, right? So this is what I refer to as the ontological security. What is the thing when what is my value going to be is over here. That's different than what should we do now and how should we invest and at least create the financial security.
Well, to that point, how do I invest around this? Where are we in sort of the investing timeline? Because for so long it's been about the chips, the picks and shovels, the NVIDIAs out there. Now where are you investing? Are you investing in the companies that are doing the using, that are doing the disrupting here?
Right. Well, great question, because I'm glad you asked, because for the internet, it was like a 15-year time horizon before we truly figured out how to build a commerce around this. And this is like a long time is what, Katie, 24 months? So what we're doing is we continue to invest in the infrastructure build out, and then you really want to lean into the thematics. So it's not about the Magnificent Seven anymore. It's about magnificent thematics, and there are 4, and they're all accelerating and interacting as a cohort in the same time zone. Okay, so one is deglobalization, which puts you into, wow, things are going to be more complicated, and obviously military and defense spending, which puts you in industrials and materials, should be in your portfolios, 2 of the best performing sectors year to date. Common sense kind of stuff. Artificial intelligence build out, but understand that the accelerant to AI is deglobalization, because it's a cost-saving, productivity enhancing technology that can replace the complexity and politics of human labor and the cost of it. And then number 3 would be longevity, because AI is accelerating the advancement. And then here in the United States, I would say domestically it's deregulation, which also becomes an accelerant. So as you kind of chapter those out into the sectors, it's tech, industrials, materials, consumer staples for income.
I love
I have a lot to say about this.
I love your thematic look, and I would love to get you back on specifically to talk about that longevity trade, because we've been hearing a lot about that. Sherry, we have to let you go. Sherry Paul, Managing Director, Private Wealth Advisor at Morgan Stanley Private Wealth Management. Some breaking news right now. This on CSX, the shares turning higher. This after Bloomberg is reporting that Goldman Sachs is apparently working with CSX, the railroad, on strategic options. Of course, this comes just a couple of days after we learned a tie-up between Norfolk Southern and Union Pacific, the other 2 big railroads here in the U.S.
Right, and this was the speculation, who is next? We know that the CEO of CSX had said this month that he's open to merger talks. It looks like potentially we're seeing that underway. Still has to be seen whether it culminates into anything.
All right, those shares are turning into the green right now as we continue to keep an eye on big tech with Amazon and Apple on tap after the bell. Full coverage of those earnings and a full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. It's already started. There's Carol Massa. There's Tim Senovic in the radio booth. Welcome to our audiences across Bloomberg Television, radio, our partnership with YouTube. A rally to start the day, one that looks like it's going to end in the red despite big gains from Microsoft and Meta.
Yeah, it's really kind of fascinating to see where the overall numbers are going to end up here. I've been looking at pharmaceuticals. They're down about almost 3% here as a whole. Of course, we heard from the White House some pressure from the president for U.S. drug makers to lower prices. So again, sector specific within what is kind of an overall down market.
Seeing some exuberance, though, when it comes to IPOs, at least in recent days, and today included. Figma shares up 256% as we speak. The IPO was $33 a share. It's at $117.90 right now.
Yeah, just amazing gains on their own, perhaps made more remarkable by the fact that we are now in a down market, but still Figma sort of trading in its own universe. Going to be interesting to see if that coaxes more of these companies out of that IPO pipeline, which has been heating up a little bit.
Yeah, and you think about the ones that we've had as of late here. You talk about a Circle, which of course had a relatively phenomenal post-IPO move, similar with CoreWeave as well. In fact, prior to today, CoreWeave was actually one of your best performing IPOs of the last few months. Figma's going to take that title in just about 20 seconds time as we get the closing bells here in New York. And we've got a lot to get to here in the after hours with tons of earnings, including from Microsoft and, from Amazon and Apple. It was Microsoft and Meta last night. That's one of the few reasons that you're seeing the NASDAQ composite finish the day just barely in the green, up about 10 points as we wait for these numbers to settle. The S&P will decidedly end in the red, down 20 points or 0.4%. The Dow down 0.8%, and the Russell 2000 lower. That's your laggard on the day by almost 1%.
Hey guys, most names in the S&P 500 lower today, about 365 to the downside, 137 gaining ground.
Keep going.
Paramount? Oh, okay. So let's talk about Paramount, if we will, because it's crossing the Bloomberg terminal as we speak. Ticker, of course, is PARA, and let me bring up the numbers here. Let's go to second quarter revenue. The company, $6.85 billion. That is just pretty much in line. The street was looking for $6.87 billion. Second quarter adjusted EPS, continuing operations, 46 cents a share. That compares with an estimate of 37 cents a share. We are seeing the stock, I think, initially, are we seeing it?
Yeah, it's kind of fluctuating, Carol, between gains and losses here. Of course, the stock that is going to be absorbed into Skydance and repurposed, if you will, one of the many earnings that we're waiting to cross the wire, and that includes Amazon. Carol, I believe Amazon earnings now on the tape.
All right, so let's get to it because we did see the stock gaining in the regular trade. Let's get to it. Second quarter EPS, $1.68. That is 35 cents better than the street was expecting. Second quarter net sales, folks, $167.7 billion. Again, that's a beat. 162.15 was what the street was looking for. AWS, always important. Net sales ex FX up 17%. That's in line with what the street was expecting. Second quarter operating margin, 11.4%. That too, Tim, is a beat. 10.4% was what the street was expecting. Outlook, always important, sees third quarter net sales of 174 to 179.5 billion, and Tim, the street was looking for 173.24. So that's a beat. Stock right now up about 1.25% here in the aftermarket.
Looking at what Andy Jassy says to shareholders, our conviction that AI will change every customer experience is starting to play out as we've expanded Alexa Plus to millions of customers. Continue to see our shopping agent used by many millions of customers. Launched AI models like Deep Fleet that optimized productivity path with our 1 million plus robots, made it much easier for software developers to write code. In addition, he says our AI progress across the board continues to improve our customer experiences, speed of innovation, operational efficiency, and business growth. Andy Jassy is excited, he says, for what lies ahead. Shares now lower by about 1%.
Let's talk a little bit about what they see ahead. Third quarter net sales between $175 billion to $179.5 billion. The estimate had been for $173.2 billion, so a little bit of an upgrade there. AWS, just to go back to it, remember there was a lot of focus on this because it's AWS, but also because we saw Microsoft put up big numbers yesterday when it came to Azure, but it looks like net sales for AWS beating as well.
All right, just real quickly, Roku shares higher in the after-hours trade as well. The company coming in with second quarter EPS of about 7 cents. The street was actually looking for a loss, so a beat on that metric. Revenue up 15% to $1.11 billion, and that is a beat over what the street was looking for, guys.
Hey, I just want to mention, I'm going to go to First Solar in a moment, but Amazon sees third quarter operating income of 15.5 to 20.5 billion. The estimate on the street is 19.42 billion, which might explain some of the bouncing around that we've seen in shares of Amazon in the aftermarket. So we've seen it. Let's pull it up. It's down about 0.6%, Romaine.
Let's talk a little strategy. The company formerly known as MicroStrategy, they've increased their fiscal year 25 Bitcoin gain target to $20 billion from $15 billion. The company sees fiscal year 25 earnings per share of $80 per share based on $150,000 Bitcoin outlook. Remember, Bitcoin's just shy of $120,000 right now. Sees net income of $24 billion. Sees fiscal year operating income of $34 billion. Their second quarter cash and cash equivalents has missed estimates. Shares in the after hours are, well, I can't really tell right now. Up about 0.5%.
All right, breaking news also here on Fannie and Freddie. Both stocks moving higher in the after-hours trade. This after a report by Bloomberg citing people familiar with the situation that President Trump has met with leaders at J.P. Morgan, at Goldman Sachs, and at Bank of America at the White House and asked them to devise a plan to monetize the mortgage giants. Remember, these are effectively the government-sponsored enterprises that have been in conservatorship since the financial crisis back in 06, 07, 08. A path, maybe, potentially, to being released from that conservatorship.
Interesting to see this breaking news because, of course, we learned earlier today that Goldman CEO David Solomon was meeting with Trump on Thursday afternoon. We know that he invited J.P. Morgan's Jamie Dimon last week. I believe Brian Moynihan also scheduled to appear there. Now some details about what exactly they're talking about, and certainly a hot topic there.
Yeah, no doubt about it. These quasi-public-private enterprises have always been fascinating. All right, let's get to another earnings crossing. We're talking about KLA Corp crossing the Bloomberg terminal. Let me just pull it up here on my Bloomberg. And you've got KLA fourth quarter revenue, $3.17 billion. That's a bit of a beat. The estimate on the street was $3.08 billion. Fourth quarter adjusted EPS, $9.38 a share. That is certainly some outperformance there. The street was looking for $8.55. Let's go to the outlook. First quarter adjusted EPS for KLA, they're looking for adjusted EPS in the first quarter of $7.76 a share to $9.30 a share. The street estimate is for $8.17. Right now we're looking at KLA 10 Core up about 1.6% here in the aftermarket.
In the aftermarket, shares at Coinbase down more than 3%. Remember, these shares were up 52% going into the print today. The company with second quarter subscription and services revenue that missed estimates, coming in at $655.8 million. Total revenue for the second quarter coming just shy of estimates at $1.5 billion. Trading volume coming in shy of estimates at $237 billion. And second quarter transaction revenue coming in at $764.3 million. That's shy of estimates of $810 million. Once again, shares right now lower by about 5.4%.
Well, I have a good news story, and that is what's going on with Reddit, of course, reporting, and you can see that shares are up 11% after hours. That's after Reddit raised its third quarter revenue forecast. They now see revenue for the third quarter between $535 million to $545 million. The previous estimate was for around $473 million. So a big boost there, and it also helps that they beat on second quarter revenue as well. So a beat and a raise coming out of Reddit.
And I'm just going to squeeze one last one in. Rocket Companies just reporting as well. Shares higher by 8% in the after hours trade. The mortgage company saying that adjusted revenue did come in above estimates at $1.34 billion. EPS coming in above estimates at 4 cents a share. And the guidance for the third quarter, the company says revenue should be in a range of $1.6 to $1.75 billion.
And just quickly want to end in First Solar because we're seeing that stock move up about 4% in the aftermarket. Second quarter EPS $3.18 to $2.66. Talking about the outlook, sees fiscal year EPS of $13.50 to $16.50 a share. That is above $12.50 to $17.50. So bit of a range there, but nonetheless, we are seeing that stock, which has been under some pressure, up about 4.6%. And just a reminder, we've got Amazon now down about 2.3%. Apple coming your way in just about 23 minutes. All right, guys, that's a wrap. Across platform coverage, radio, TV, YouTube, Bloomberg Originals. Romaine and Katie continuing there on their coverage over there on TV. Tim and I continuing on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. Amazon shares down more than 2% after reporting earnings for the second quarter, a 13% bump in revenue to $168 billion. That is a beat. It's also a beat on the bottom line and the forecast. The company says net sales for the current quarter, the third quarter, 174 to 179 billion and change. That would be above street estimates. Caroline Hyde, the co-host of Bloomberg Tech, joins us right now. I know you had a little bit of time, a couple of minutes to look through the release. Anything jump out at you?
I think it's the operating income forecast that falls below the midpoint estimate. So when you're thinking of $15.5 to $20.5 billion for the next quarter, this is maybe an admission that yes, growth is going to come, but maybe profitability has to be held off as they continue to spend on capital expenditure. You think about the cash that they have on the balance sheet, that's coming down significantly year on year in their fiscal second quarter. This is a company that has to invest to meet demand. And what we're hearing is that from Alphabet, they invested. Yeah. You're hearing investment from Meta and from Microsoft. And maybe just Microsoft's outperformance on Azure got people thinking that cloud would grow even faster for AWS. And maybe they did meet expectations, but they didn't beat them in the fiscal second quarter.
But I am curious about the CapEx spend. You mentioned Alphabet. They got rewarded. Their stock got rewarded for that CapEx spend. We saw the outsized projections that both Microsoft and Meta gave last night for how much they are spending and how much more they're going to spend. And you saw those stocks close at record highs today. I know this is just the initial knee-jerk reaction in Amazon. Yeah. We got to parse it. We got to wait for the conference call. But are you surprised that investors aren't more embracing this?
Yeah, and also considering that Amazon hasn't outperformed the S&P 500 so far this year to date. Yes, they're up, but not as much as the S&P has been, therefore not as much as the Nasdaq has been. When Alphabet had underperformed, but Meta and Microsoft have overperformed, and they still got so much love. I think what's been built in is the idea that these other cloud behemoths have been beating on the expectation. And I think if Amazon coming in at 17% growth for AWS, sure, that's great, but it's not 39% growth that we saw for Azure. Of course, AWS comes from a position of strength and leadership, and their growth has been slightly slower than the others.
I'm also curious about the valuation for the stock, because when you look at the big tech stocks, and particularly the Mag 7, this is probably one of the most diversified in terms of where it gets its revenue from. Obviously, the e-commerce side, which is what we mainly know it for, AWS, which has become the main growth driver, but they've got advertising, they've got streaming, they got product, actual devices, and I know I'm forgetting a few other things that they're probably involved in.
They're bringing satellites into space.
They own us all, right? I mean, I once read a whole story that you can't get through your day without interacting in some way or another with an Amazon product. So why don't investors reward that? Do they want a more narrow focus for this company?
I wonder if there's an expectation to what we hear on China and the exposure there. This has been a company that's been confronted with tariffs far more than others. Now, of course, Apple comes in but at 20 minutes' time. They too have been in the tariff headwinds. But it'll be wondering as to, remember, exposure from the advertising part. We actually saw Meta manage to withstand any headwind from big Chinese e-commerce giants. But what have the third-party senders and sellers been spending on Amazon in terms of advertising? How much they committed to Amazon and the US consumer more broadly. We want to get a picture of that. And I think that sometimes diversification doesn't win in every single way. And at the moment, Microsoft has been a bet on AI. Amazon is a bet on AI, but also satellites, but also e-commerce, also the retail and the US consumer and Chinese sellers.
Do investors not take Amazon's AI strategy as seriously? Because it's, I mean, I guess it's a singular focus, like Meta is all AI now, Microsoft to a certain extent, obviously NVIDIA. I understand why maybe, okay, they're not a pure AI play, but why would anybody discount their ability to spend and catch up with the others? We know they have the money, and they certainly have decent management that can execute on it. So why not reward them?
And I almost wonder whether or not they're not playing catch up in cloud. They lead in cloud, but I wonder how much people are starting to understand the real benefits. I think what Meta and Microsoft have signaled so well is how much the investment that they've made in generative AI is reaping rewards from a revenue growth perspective. Can Andy Jassy, he's saying it's making benefits across his entire business model. But remember, they're trying to compete on every front. They're trying to take on Cursor within generative AI coding product. They've got Kuiper, that they're taking on, the likes of what Elon Musk is doing with satellites. They're trying to also be where you go to for your generative AI products, where you build them, and also where you learn in more broadly is to use some of their generative AI models too. They're kind of trying to take on every single segment, and I think Andy Jassy needs to weave that into the overall commitment that, look, we're spending big. Their capital expenditure is $100 billion. How much of that exactly is going into data centers? How much of that exactly is going to chips? And I think people want to understand their chips in particular, Trainium and the like. How much is Inferentia taking a little bit of pressure off having to get NVIDIA supply chain into their data centers more broadly? So I think Andy Jassy's got some work to do, but I don't think anyone discounts them as a key player when it comes to generative AI. But it has almost been put second fiddle to where Microsoft wins in terms of cloud.
All right, Caroline Hyde is the co-host of Bloomberg Tech. A nice breakdown of those Amazon earnings, and actually great coverage earlier today down at the NYSE on Figma IPO. But we want to continue our coverage of Amazon and bring in Brent Thill, tech sector leader of software and internet research over at Jefferies. Brent, what did you make of their earnings?
It was mediocre. You look at the AWS number was really in line. Their margin fell out of the sky from 40% to 32% in the AWS business. They've been saying for a while that AWS margins are too high, but I go back to
I didn't know that.
They needed bigger numbers to effectively have a bigger upside in the stock, and they just didn't deliver. So from our perspective, I would just say, like, overall the numbers looked okay, wasn't amazing. Microsoft's gaining share, there's no question. There should have been a bigger inflection. You saw an inflection at Google, you saw an inflection at Microsoft, you saw an inflection at Meta. There's no real inflection. So the ad business in Amazon did a little bit better. Retail margins a little bit better. AWS in line, but the margin again fell out. And so when we've said the number one thing investors look at is AWS, it's the lead horse as it relates to the valuation in this company. And that was, as they say in The Voice, for whatever singing show you want to say, it was a little pitchy, not as good as we've seen from other performances.
I am curious about, I mean, we're talking with Caroline Hyde earlier about the kind of diversified nature of Amazon's business, at least relative to some of the other players in the tech space, particularly, like an NVIDIA or even like a Meta. Does that diversification actually work against them?
It does, because here's why. So institutional investors, when we talk to our clients, they are looking at Amazon either from a consumer lens or a tech lens. And most of the tech investors are like, well, I should just probably own Meta and Microsoft based on their performance versus owning AWS, from what I just told you. And then if you look at the consumer side, right, this isn't an amazing business, right? I mean, it's a big revenue business, but the margins are single digits. They're low single digits. And when you think about tariffs, they are impacted at a higher rate than perhaps Walmart and others. So I think most of our investors are like, look, I'd rather be in Walmart, I'd rather be in Microsoft, I'd rather be in Meta. And so you have this divergence. To your point, I think the diversification right now is hurting them. And this is more of a portfolio management perspective of, hey, they just feel like they have better consumer sleeves, and then you have better tech names you can own at this point. So again, I'm a fan of Amazon. I think Jassvy's done the right thing. I think he's a software guy. We are 30 years in the software business. He understands high margin businesses. He doesn't like low margin businesses. The unfortunate nature is you had a massive contraction in AWS's margin, and everyone's been asking for this margin contraction for them to invest in AI. So they are behind in AI in our perspective. They haven't lost the race. But I think this is, perhaps maybe good signs they're investing more here in AI.
Are you comfortable with the CapEx spend? Is it at the right amount? Do you want it to go up? Do you want it to go down? What?
I think we're comfortable. You saw just in the last week, we've raised CapEx by $50 billion across Google, Meta, and Microsoft. And then Amazon's CapEx numbers were higher than forecasted in terms of the numbers. So the numbers this quarter for CapEx, again, we're a lot higher. We were at 25.7 billion, and they came in at 31.4. So again, I think it's a common theme across all the hyperscalers. CapEx is going higher. Constraints are there. Meta, Microsoft on the callbacks last night said they're capacity constrained, more demand than supply of AI. So they have to keep investing. So this makes sense. I don't have any issue with the CapEx number. I think the issue is the AWS business not accelerating and a bad margin. And that, again, that's your lead valuation for Amazon, and that's what's dragging the stock down 4%.
There's been a lot of talk. I mean, it's been, I don't know, what has it been, like 4 years now since Jassy's been at the helm. And there has been some talk about whether there needs to be some sort of strategic M&A, meaning not just buying companies, maybe even potentially divesting or spinning off something in order to make the company, and for that matter, the stock, more nimble. Is that something you would be supportive of, Brent?
I mean, I think what he's done is pretty amazing. You see, he's improved margins. He's held double-digit growth. I think he's gotten away from, the risky bets to the more certain bets. He's, again, the individual that led and built AWS, have huge admiration for what he's done. And I think, again, he hasn't said this to me, and I have not met with him. But I can tell you that most software people I know like the software business for a reason. High recurring, high growth, and big margins. Amazon does not have that in any other business other than their ad business. And so, I like him at the helm. I don't think they have to do anything dramatically different. I don't think they have to go out and buy an AI company. I don't think they have to divest anything. I think they have a lot of the assets. And it goes back to they have to innovate faster at the core. If you ask industry experts, they believe Amazon can do more in AI. And they believe that Microsoft and others are doing more, Meta doing a lot more, and leaning in harder and showing the returns, the tangible returns, showing that advertising went up 9% because of AI on Meta's call last night. So I think Amazon needs to showcase more of that. And I think they have a lot of the organic components to do it. But yeah, if they got a hall pass right now, I think every investor would say, go acquire the AI talent you need. We're seeing $100 million checks for individuals to run AI businesses at other hyperscalers. These are crazy numbers.
Yeah.
But it's what it's taking. And so they, I think that's an area that investors would say, like, it's the right thing to do.
Yeah.
If Zuckerberg's doing it at Meta and Nadella's doing it at Microsoft, Amazon needs to step up too.
All right, Brent, we'll let you get back to it. Awaiting that conference call, Brent Thill, tech sector leader of software and internet research at Jefferies. We're going to get back to Amazon in just a second, but just want to bring you in the loop on some other earnings that did cross the wire. That includes on Clorox. Those shares up fractionally in the after hours trade as the company did say that software switch that we had been talking about a few weeks ago did disrupt retail orders. Nevertheless, the company did beat on the bottom line and its guidance for the fiscal 2026, 560 to 595 on the bottom end. That is on the bottom line, that comes in below street estimates. Meanwhile, Reddit shares having a phenomenal trade here in the post market after beating on the top and bottom line. A mixed day for Coinbase in their results, and you see the shareholder reaction there. And of course, we should point out Coinbase has been on a phenomenal run, more than doubling off of since early April. And then there at the top of your screen, Cloudflare, that's just crossing the wire now. That company saying that in the most recent quarter, it did see adjusted EPS beat, it did see revenue actually beat, and it guided higher on both the top and the bottom line. We do want to turn back to Amazon. Those shares have been fluctuating between gains and losses, now down about 3.5%. We were talking with Brent Thill about Amazon Web Services, about the AI strategy. But, well, what about the traditional retail business? Sales there were still up 10 to 11% in the quarter, but some concerns here about the long-term durability of where they go next. Katherine Black joins us right now, a partner over at Kearney, leading the food, drug, and mass market retail business. Great to see you, Katherine.
Great to see you. Thank you for having me.
There is an issue here with what Amazon is supposed to be. I mean, obviously, traditionally, it's a bookseller, it's a retailer. We know it's so much more than that. But when you look at the e-commerce side of the business and what it's evolved to, how do you grade it right now? How is it running?
Well, look, it's very mature. It's obviously in the sectors that I look at, it's the most mature of all the retailers. And because of that, it's hard to grow at the same rate as everyone else. And they're not really doing that, but they're continuing to grow at a massive scale. And I think what Amazon has done better than any other retailer is their ad business. We heard it in the last segment. They have the best penetration on their ad business. It's growing. And when I talk to brand buyers about how they're spending their marketing dollars retailers during this interesting tariff time, they're saying, hey, I'm shifting to retail media, and I like the big players like Amazon.
I am curious about competition, and I can even speak from personal experience. There was a period a few years ago where basically the only place I shopped online, at least for a broad-based goods, was Amazon. That's changed in a big way today.
Yeah.
I mean, Target has stepped up their game, Walmart has stepped up their game, and a lot of individual brands are doing a great job now of direct-to-consumer in a way that you didn't have even just a couple of years ago. Does that hurt Amazon?
Well, look, yes, a lot of brands stepped up. They had to step up in 2020, and we've seen that accelerate since then. There's really only one retailer that's outgrowing the natural market growth in e-com, and that's Walmart. They're on a much smaller base. And for them, they had a lower end customer to begin with, and their e-com business is bringing in a new customer, a higher end, less price sensitive customer. Amazon's customer traditionally has been that higher income household, absolutely. Yeah. And they've been competing against things like Club that in the past didn't even have an e-com offering. So certainly a player of the scale and type of offering that Walmart has, particularly in this economic environment, is going to pose a big competitive threat to Amazon.
What is the potential tariff impact on a company like Amazon? I know they sell certain things themselves, but I know a lot of it is with third parties, but that still has to have an effect if those third parties are facing higher costs and maybe lower sales.
Absolutely. Look, every retailer is watching tariffs very closely, wondering exactly where things are going to go and exactly how they can do the best for their customers, and I think Amazon is no exception. They're certainly very exposed in some categories that are going to be more heavily impacted, we think, than other categories like apparel and electronics and those type of goods. Their grocery business isn't as large as some other players' grocery business, which is a little bit more insulated from tariffs than some of those categories. So they definitely have some exposure, but I would expect their scale and their supply chain finesse to help them manage through that effectively.
It's funny you bring up their grocery business. What do you make of Amazon's strategy on that? Because I mean, when they bought Whole Foods, there were a lot of people saying, okay, what are they trying to do? And I know they've had some reorganizations in the structure of that overall umbrella of grocery business. How does that stack up?
Look, grocery is a very difficult business, full stop. And I think Whole Foods made sense for them in the sense that, again, they had a very upscale customer, and that's also what they had with Whole Foods, and it was a nice, manageable footprint. I think in order to be a real player in that space, they need more scale. I think the dynamics of where we're going with tariffs and also with agentic commerce, which you've talked a lot about today, will probably force some more M&A and consolidation in the space, and so they've got some opportunities there.
There's this idea that the consumer is sort of this monolith, and I know there are a lot of layers, and you talked about obviously the difference between upper income and lower income, but there's a lot of layers in between that. As retailers, whether it's Amazon or anyone else, particularly the diversified retailers, try to sort of carve out their space. Should it be something that's a little more niche, where you're just targeting one very specific group of consumers or a couple of specific groups, or does it help to be just, we want to be everything to everybody, as Amazon used to call itself, the everything store?
Yeah. I mean, look, you can't be everything to everybody, but I think most retailers' economics are based on serving a broad church of consumers, and so they do have to have offerings that cater to a broad range of consumers. So that doesn't mean the same thing for everybody, but it does mean a wide range of offerings. And I think being really clear on the consumers you're serving and where you can drive growth as the environment and the market changes is going to be really critically important.
I just have to get your thoughts before you leave on just kind of economic conditions overall. I mean, you guys at Kearney do a lot of great research on this. I mean, what is the health of the consumer? Because sometimes I'll look at one of the economic data points and everything seems like it's great, we're still spending, and then I'll hear some commentary on a conference call that's all gloom and doom. Apparently, you know, we're all just hiding in the house and not spending any money.
It's very confusing right now. I'll tell you, more than any time I've seen in recent memory, a lot of consumers are watching price and they're changing their behavior, but they're not stopping shopping. I would call it power buying, where they're being very savvy and very selective about how they spend. They are waiting for promotions and coupons. They're shifting to maybe a cheaper store or a cheaper brand to manage their budget, and they're making decisions, but they're not stopping shopping, and you'll see different reactions in different segments again. So it's a really nitty-gritty question that people try and answer in broad brush answers, and that doesn't work, and it becomes confusing.
Yeah, and that's of course why people like you and Kearney exist.
There you go.
Katherine Black over at Kearney Partners here helping us break down those earnings out of Amazon. And we should point Amazon right now is the fifth of the Mag 7 companies to report earnings. In just a few minutes, we're going to get the sixth of that cohort, and that is Apple. The iPhone maker expected to report modest sales growth. Ed Ludlow is the co-host of Bloomberg Tech, and he joins us right now. Ed, obviously this is the perpetual cash machine, but a cash machine that a lot of people are concerned about, that there's not necessarily any real innovation behind that. What's going on?
Yeah, it's also, by the way, interesting to see an after-hours gain of almost 1% ahead of the numbers dropping. That's actually quite odd and unusual for that to happen. I've seen it happen with NVIDIA. Modest growth in comparison with the other Mag 7 that are seeing very high growth. And the reality is that Apple is still getting more than half of its revenues from iPhone. It is the movement of a electronics good across borders, and so tariffs is the main story. The CFO told us on the call last quarter that in this fiscal third, it will be an impact of $900 billion US. That seems small for a company that's expected to book $89.3 billion and what would be a fiscal third quarter record. But there's exposure there, and the expectation is they'll have to explain it away and give us the longer term story on AI as well.
Where is the excitement, Ed? And I asked that for a couple of reasons. This is a loaded question, but I was watching your coverage earlier today on Bloomberg Tech with Caroline Hyde. Everyone going gaga over Figma. You got Meta hitting a record high, Microsoft hitting a $4 trillion market cap, and of course, NVIDIA is just NVIDIA. And then I look at the performance of Apple stock, and I look at the way people talk about it, and I do wonder what happened to that excitement and what they need to do to get it back.
Well, the first half of the year, Apple stock traded on the discount of concern about tariff. And more recently, as we entered 2H, the pressure on the stock has been AI related. The Figma part is that, as your previous guest, I think, said, Brent Thill, a lot more excitement about higher margin software businesses. The problem with Apple's AI play is there's no tangible yet. There isn't evidence that the AI offering, which we know has been not to the fullest extent rolled out, is driving people to become Apple customers for the first time, which would show up in services revenue and services gain, or driving them to buy an iPhone handset for the first time. They're just not quite there with it. So I appreciate your question because I think it's the right one.
Yeah.
The stock isn't getting any credit for what's already been done with AI, but the market also doesn't understand what comes next.
Hey, Ed, if you had one question on the conference call at 5 p.m. tonight, 2 p.m. your time, what do you ask?
When are you going to fight back on talent, and how's that going to help you to get the rollout of Siri or Apple Intelligence escalated, brought forward more quickly?
Ed Ludlow, the co-host of Bloomberg Tech, as we wait for those earnings out of Apple. Expectations on the street right now, revenue of $89.3 million, with services revenue making up about $26.9 billion of that. And on the bottom line, $1.43. Those are the numbers, but more important than those numbers, of course, will be some sort of articulation of what the long-term strategy is for this company. Is it just a cyclical iPhone maker hanging on to that smartphone cycle, a cash generation cycle, or is it something more? Those earnings now hitting the tape right now, and it looks like we have a beat on the top and bottom line. Third quarter revenue, the fiscal third quarter, $94 billion. The street looking for 89.3. Third quarter EPS, $1.57. The street was looking for $1.43. Operating expenses in the quarter, $15.52 billion, right around what the street was looking for here. Wearables revenue, 7.4. iPhone revenue, 44.6. And iPad revenue, 6.5. iPad revenue and wearables revenue coming in below estimates. iPhone revenue coming in above estimates here. And then Mac revenue, we should point out, also coming in above revenue, $8.05 billion. The street was looking for $7.3 billion. Dan Flax joins us right now, Managing Director and Senior Research Analyst over at Neuberger Berman. And Daniel, I know you haven't had a chance to really strike through these numbers, but the numbers almost seem immaterial. There's growth. We know that. And it's coming from the traditional places we would expect to see them. When you think about where the stock can do, what the stock can do next, and whether it can actually catch up with some of its peers in the big cap tech space, what do you want to see out of it?
Good to see you, as always. I think what we're going to focus on is continued execution of the product cycle. Product cycles, we obviously have iPhone 17 coming in September. The key here is really, can this company continue to reinvent itself? Recall the iPod over 2 decades ago. Clearly, the iPhone remains critical to the business, and that franchise, in my view, remains durable. I think the services business remains healthy. And so when you pull all of this together, you have a company that's been successfully empowering others to innovate on top of its platform. I think you'll see more and more of that with Apple Intelligence over the next several months and into next year. So we like the stock. I do think it can catch up to some of the other names. We remain long-term owners, and I think with a 12 to 18-month horizon, the shares are attractive.
There's been a lot of criticism on Apple over the last year or two about the idea of what its AI strategy is. Why aren't we seeing the same headlines out of Apple that we see out of Meta, Microsoft, NVIDIA, and the other cohorts? Does that concern you?
Each of these companies has a different business model. And so if we look at Meta, which had strong results, their advertising business remains healthy, and they're continuing to push ahead with AI, and generative AI remains a lot earlier for them. With the cloud companies, we saw that with Microsoft Azure, AWS results this evening, and of course, Google last week. The cloud businesses are seeing very strong demand, and so that's helping those companies. With Apple, it's about evolving the user experience on the device. And the other key element for the Apple story is this focus on security, on a trusted private user experience. And so Apple, in my view, is going to look to put that front and center with the Apple Intelligence experience. And the key is for them to get it right. The history of this company is that they may not always be the first to market, but if they come up with a differentiated experience, that, in my view, is what will drive growth as I think about the year ahead.
There's been a lot of talk about the tenure of Tim Cook. I think we're coming up, I believe, next month on something like his 14th anniversary as CEO of this company. He's lost a lot of top managers over the last year. Now we're hearing a lot of reports of him losing a lot of top engineers as well. Is there any chatter amongst the investor class about maybe talking about some sort of succession plan away from Tim Cook?
If we look at the history of the company, they've been successfully transitioning executives. You have a CFO, Kevin Perek, who succeeded Luca Maestri. Kevin is also a strong executive. Luca is still with the company as one example. And so you have Jeff Williams, who's going to be retiring. He will stay with the company a little bit longer. And so I look at some of these transitions as a very natural part of the evolution of the leadership structure. I think Tim Cook has been an exceptional leader of the company. And part of what he has done so well is empowering other executives and empowering the developers. And so that has contributed to the magic, if you like, of Apple. When I think about AI talent, the industry, Silicon Valley, there's always going to be poaching of researchers and critical talent from one company to the next. I don't expect that to change in the near or the medium term. I think Apple has a lot of talent. I think they'll continue to add talent.
Yeah.
And if you think about the story, it's not just about internal talent, it's about partnering with others and bringing the experience to users.
What's going on with regards to their international exposure? I just want to read off the China revenue for the most recent quarter. It did beat expectations, about $15.4 billion, Dan. That's about a 4% increase and slightly above what the street was looking for. And I think a lot of people were expecting maybe even something worse because of all of the back and forth and tit for tat between the U.S. government and the Chinese government over trade and tariffs. Is the Chinese business, meaning what they sell in China, going to remain a viable part of what Apple is?
If I look out over the next year or so, I expect the dynamics and the trade tension to continue. We've actually seen that for many years, but at the same time, Apple has been able to grow the China business over the last several years, and it's driven by the innovation, the products that Chinese customers love, and of course, a services business and the ecosystem there that, in my view, remains healthy. I do expect the trade tension, though, to be a factor at times, but ultimately, it's going to be about the innovation, the execution on the product cycles. And if Apple is able to deliver value to Chinese customers, then I think that business there will remain healthy over the next 1 to 2 years. The Chinese economies, of course, had some challenges, but I think through that, Apple has invested in the country and I think still has a bright future there if I look out over the next couple of years.
And of course, the flip side of that in terms of what they sell in China is, of course, what they make in China and export overseas. Is there any sort of risk, particularly with what we presume is going to be a big announcement this fall of the next iPhones and other devices? Is there any concern here that people buying those devices, the end consumers, are going to see much higher price tags because of the tariffs?
The price of new devices has been going up over time as Apple and others in the industry infuse more and more silicon and intellectual property into the device. And so you have seen prices go up. Apple could choose to raise prices on some of its devices in the fall. The key, though, is that as a user, if you're able to trade in your older device, you're not going to pay full price. The other important thing is that there are a variety of payment plans. And so, again, from a monthly perspective, it helps with affordability. If I think, though, about the direction of travel here, this is about evolving the iPhone experience, more and more capabilities across payments, obviously video, camera, health. As that finds its way into the device, it becomes more valuable to the users. And what we've seen is that users are paying for the iPhone, the Pro and the Pro Max, because they value the additional capabilities. And I suspect we'll see that continue, even as prices may drift up a little bit to offset some of the higher costs, including tariffs.
All right, Dan, always appreciate you taking time for us. Daniel Flax is Managing Director and Senior Research Analyst over at Neuberger Berman, as we keep an eye on Apple shares, slightly higher in the after-hours trade as we await for that conference call to start. At the top of the hour, we'll get a little bit more clarity on the guidance going forward, but for the quarter that just was here, a beat on the top and the bottom line. There wasn't a whole lot of talk in the press release about the artificial intelligence or Apple intelligence strategy, but for some investors, they say maybe that doesn't matter. Maybe the slow approach is a little bit better than the throw cash at the wall approach that we're seeing from other companies out there. Nevertheless, some investors are still calling for a dramatic pivot in the AI game plan, particularly with some concerns about whether the smartphone cycle will continue to slow. Let's bring a pioneer in the AI space into this conversation. Andrew Ng is a managing general partner at the AI Fund. And Andrew, there's been a lot of talk about what wins the AI race. Is it kind of the Meta, Microsoft strategy, spend as much money as you can, as fast as you can to secure your place in the AI space? Or is there a model out there that's a little bit more of tortoise rather than the hare?
I feel like the value of AI will be immense. But exactly where the moats are still being determined. So I know that some companies have looked at, Meta and other companies, CapEx and Microsoft and so on, and commented on how large it is. But given how transformative AI could be, say for Meta's business, which you mentioned, Meta uses people to generate content that then it sells ads against. If AI can engage an equal, even larger number of attention to sell ads against, it could be very transformative for the business models of social media companies. So I think Meta's significant investments and various other business investments feel pretty rational to me, given the upside and the downside risk. But I think there'll be room for plenty of winners. There's some businesses where it's clear there'll be maybe one or two winners. But given the diversity of AI applications, I think there's room for plenty of winners. And one example we just saw today, I was very happy for Dylan Field that Figma's IPO.
Sorry to cut you off there, Andrew. I was just agreeing with you. I mean, there was all the excitement. That was all anybody can talk today. And it does get to this idea, and I know we've had you on the program before. We've kind of asked, is there an AI trade beyond, the NVIDIAs and Microsofts of the world? And Figma is probably Exhibit A that, yes, there is. I do want to get your thoughts, though, on sort of the overarching guidance of AI strategies, more from the top down, meaning from the government level. The White House last week came out with this AI action plan, in their words, a way for the U.S. to win the AI race. We've gotten some insights into what China is trying to do in that space, and who knows what Europe is doing, but they also have a plan as well. How do they stack up?
I was happy to see the White House plan announced. It's strong. I especially appreciated the strong support for open source software and open waste models, software that anyone can download and use, usually for free. I was a little bit wondering, there are some parts of it that seem to promote various flavors of viewpoint diversity. So I think how those things are implemented, we'll have to keep an eye out on. But overall, I thought it was strong. But I'm going to say something that may not win me a lot of friends in DC, which is I feel like there is a path for China to overtake the US in AI. I think this was nearly unthinkable 2-3 years ago, 2.5 years ago, when OpenAI first released ChatGPT. The US was so far ahead of China. I feel like China had dropped the ball on this. But China now has a very vibrant open source, open weight model ecosystem. The business dynamic in China is hyper competitive. Tons of AI companies poaching each other talent, undercutting them on pricing, making bold PR announcements. So that cauldron of innovation, Darwinian life and death struggle, a bunch of the companies in China now, they will not survive. But that Darwinian competition will be very strong competition. And what I see right now is because of China's strong open source, open weight model ecosystem, the fusion of knowledge is very fast in China. Whereas in contrast, in the US, we hear about companies paying, massive numbers of dollars to poach each other's talent to try to know if someone has some secret sauce for some innovation. So knowledge does circulate in the US, but because a lot of the leading US companies have taken a secretive approach to model development, knowledge circulates much slower in the US right now. And so I do feel like this gives a lot of momentum to China. US is still ahead right now, but I know many businesses planning what would happen if long-term China AI is ahead of US. It's not a done deal, but it is a possibility to think about.
It's a great point. And I do wonder what you make of the commentary that Mark Zuckerberg had earlier this week, which, I mean, he didn't explicitly say they were moving towards a more closed model with regards to AI, but he certainly suggested that the open source model that they had touted, I don't know, just even a few months ago, that was something that they might actually not necessarily be as wedded to.
I would be sad if Meta steps back from the open weight model, previous impressions that they gave a lot of people. Right now, the US's leading open weight models are, I think, probably Google's Gemma and then Meta's Llama. And I feel like these have been such wonderful contributions. If the US steps back from making open source, open weight model contributions, then China will come to dominate this part of the supply chain. And arguably, it's already happened. If you look at the AI leaderboards, which ranks the performance of different models, the top models are the US proprietary models. After that are the Chinese open weight models that anyone can download and use for free. What this means is more and more developers are already downloading these, models from China and using them in their workflow. And it would be unfortunate if China solely dominates this part of this critical AI supply chain in the future.
As sort of AI evolves, I mean, we've gotten past the point of this being theoretical. We've even gotten past the point of this just being about data centers. There are now a lot of people looking at the potential consumer applications of this, particularly when it comes to things like actual devices. And there was a great story in the New York Times about some wristwear that Meta apparently is working on. I am curious, and of course, whatever the heck Johnny Ive is apparently working on with Sam Altman, do you actually see in the near future that we will see more dedicated wearable devices in the AI space?
A lot of people are experimenting with this right now. It's a little bit hard to forecast what exactly will and will not work. Maybe I know speaking about Apple just a little bit ago. Just share. I think the incumbents, Apple iOS, Google Android, do have some advantages. And just to give one example, it turns out that when you control the phone OS, you could preload your own AI model into the phone. And because these AI models are so large, they need so much memory, it's so hard to download, like a 3 gigabyte or a 10 gigabyte thing onto the phone. It turns out if you control the phone OS and you preload your model, it really puts a lot of pressure on all the app developers to use your model rather than try to download their own thing onto a phone with limited memory, limited storage. So the incumbents do have some real advantages. I feel like Google, Android is moving much faster than Apple iOS in building features, but it still feels early. And I find the room for experimentation exciting as well.
All right, Andrew, I have to leave it there. Always appreciate you taking time for us. Dr. Andrew Ng, Managing General Partner over at the AI Fund. And we do just want to reiterate a big beat here for Apple. You're seeing the shares rise in the after hours trade, and a big reason for that was 13% growth in iPhone sales. That's the biggest sales growth we've seen for those devices since the fourth quarter of 2021. Mark Gurman joins us right now, Bloomberg, who helps to lead our coverage here at Bloomberg on technology and specifically on Apple. And Mark, it's easy to kind of poo-poo this company for just kind of being, just refresh the iPhone, but it's worked. And I do wonder, as you look at the potential product lineup coming down the pike this year and maybe even to next year, is it just going to be incremental improvements to the iPhone, to the Mac, to the iPad, or is there something else out there?
For the next 6 to 9 months or so, it's going to be all incremental, but it's clearly working. right? There are people who still have iPhones that are several years old, 4 to 6, even older years of iPhone, right? There's people on Android, there's people new to the smartphone market. And clearly, the impact of tariffs didn't have a negative impact on Apple. It had a positive impact on Apple. That's because a lot of people were anticipating major price hikes to the iPhone, and they flooded Apple retail stores. The numbers I had been hearing from Apple retail stores across the United States and other parts of the world were absolutely absurd numbers I didn't believe. Revenue growth of over 1,000% in some stores because people were flooding the stores to buy phones because they thought the prices were going to shoot up. There were these completely baseless headlines on social media saying the iPhone's going to cost $3,000, a US phone's going to cost $100,000, all these complete nonsense headlines. That helped Apple out a lot. We'll see what this means in the quarters to come, but at least for this June quarter, the proof is in the pudding. Growth I mean, of 13%.
This is great insight, Mark. But as I listen to you talk, I just think, okay, well, when we start to see the third quarter results and, of course, the fourth quarter results covering the holiday season, is this a situation where we could maybe see some negative numbers because of pull forward, or is that not going to be a concern?
You're going to see the pull forward, right? But that, lucky for Apple, that pull forward is going to be offset at the tail end of the fourth quarter because that is when Apple's going to release the new iPhones. So for Q3, they got the boost from people being afraid of the complete nonsense AI headlines and analysts just making things up. And then in the fourth quarter, they're going to get the boost from those new phones. And then we'll see what happens in Q2, Q3 of next year. But at least for now, in the next couple quarters, they're in good shape.
I am curious, what's going on with wearables, Mark? I mean, we were looking at significant growth in Mac sales, significant growth in iPhone sales. Wearables down, and down relatively significantly here. What happened? I mean, it seemed like a couple years ago, or everybody was wearing an Apple Watch, everybody had these home devices. Is that just over?
People want new versions of the AirPods Pro. People want new versions of the Apple Watch Ultra. People want substantial new designs for the Apple Watch series line, right? People want the cheaper Apple Watches that compete with the lower end devices from like Fitbit and whatnot. There was no new Apple Watch Ultra last year, and that has had a serious impact on sales of that product. The Apple Watch Series 10 was a major redesign, but it didn't seriously resonate with consumers. They didn't think it was a big enough of a redesign. And even though they did come out with new low-end fourth generation AirPods, people clearly want the higher end AirPods. And so you'll see Apple come out with new versions of those before the end of the year.
All right, Mark Gurman joining us here as we continue to break down those earnings out of Apple, those shares higher here in the after hours trade. We're going to continue our coverage right now. And we're going to take a look at the streaming side of the business. And that brings us to a look back at this day in history, all the way back to 1928, when MGM's Leo the Lion roared for the first time. The mascot for the pioneering Hollywood studio traces his roots all the way back to 1924. And the three-way merger of Marcus Lowe's Metro Films combined with a studio run by Samuel Goldwyn and a separate company run by the Hollywood legend Louis B. Mayer. Metro-Goldwyn-Mayer would make a mark instantly. More than 100 movies produced in 1925 and 1926 alone, including the silent classic Ben-Hur. But it was on this day in 1928, July 31st, when MGM finally embraced talkies with the film White Shadows on the South Seas, which used a pre-recorded soundtrack and synchronized sound that allowed the audience to hear spoken actor dialogue for the very first time. While White Shadows was met with mixed reviews, MGM would go on to produce some of the most beloved films of all time: Grand Hotel, An American in Paris, Dr. Zhivago, Dances with Wolves, and of course the piece de resistance was 1939's Gone with the Wind, which on an inflation-adjusted basis remains the highest-grossing film ever made. But despite MGM's commercial and artistic success, the studio began drifting in and out of financial distress in the second half of the century. Ownership changes were frequent and often complicated and included tenures under buyout king Kirk Kerkorian, media mogul Ted Turner, and briefly a consortium led by Sony. After a 2010 bankruptcy, the company struggled to regain its footing. And then in 2022, 94 years after Leo the Lion first roared, Jeff Bezos stepped in, plunking down $8.5 billion to buy the company, a deal, when announced, that came amid a proliferation of streaming services like HBO Max and Disney+, which were all putting pressure on Amazon to acquire more programming for its still fledgling Prime Video platform. Now, that MGM deal did what it was intended to do, a massive accelerant, taking the few hundred hours worth of TV shows and movies that Amazon was producing on its own and adding 25,000 hours of a backlog of MGM content that included the rights to the iconic film franchises like James Bond. While Amazon doesn't break out financials for MGM on its own, we do know that the studio has become a big part of its strategy around Prime, a strategy designed to keep consumers tethered to the ever-sprawling Amazon ecosystem. And of course, that brings us to everything that we've been seeing here in the post-market here. Amazon shares have been fluctuating between gains and losses. You see Amazon shares down about 2% right now. Apple shares have been fluctuating between gains and losses. Of course, Apple also trying to make its mark in the streaming video space. Two companies with, well, somewhat different strategies in how they go about it. Chris Palmeri is our man in Hollywood. He joins us right now from our Los Angeles bureau. And Chris, I do want to talk about what the streaming strategy is for both of these companies, because when I think streaming, I think Netflix, I think Hulu, I think Warner Brothers Discovery, heck, even Paramount, which, you know, is okay. But you think of it. Do you necessarily think of Prime Video? Do you necessarily think of Apple?
Yes, you do, because they're having trouble. So that's sort of one of the things we've looked at really carefully. Apple has been spending a lot of money over the last few years trying to get really premier talent to make movies and TV shows. It's beginning to pay off. This year they were doing very well in the Emmys, for example. And so, you know, Severance, the studio, shows like that are really starting to resonate. Amazon, a bit more so than Apple, has really staked out sports as a territory where it can differentiate itself. And so neither of them, you know, has that sort of heft of some of the other players like Disney Plus and Netflix, but they have their distinctive strategies.
Yeah. It also raises a question about the sort of the contrast between kind of prestige TV, which I think, I don't know if it's a fair analogy, but the idea that most people look at Apple as kind of doing these more sort of a lot less content, but let's just say a lot more artistic, a lot more sort of heavyweight content, as opposed to kind of the Netflix strategy, which is just kind of just throw everything out there. Yeah, we got some prestige stuff, but, you know, we got a lot of just mindless entertainment that you'll just keep on repeat. Is there a better strategy in your view? Has anything shown up in the numbers that would say one is better than the other?
I think what everybody realizes, it's very difficult to compete with Netflix and what it's doing. It's just really spread itself into every category you imagine: reality TV, game shows, you know, the prestige kind of programming, and the kind of every person stuff. So what we've really seen is and this was particularly evident in Paramount today, the big streaming services are pulling back on the amount of shows they do, trying to focus on a few hits. They're raising prices. It's translating into not so much subscriber growth, but they're beginning to show more profits, and that's something that's really working for them.
So as we move forward here, Chris, what is, and I'm going to ask this question specifically about Apple and Amazon, what is really the additive effect of having these streaming businesses to their ecosystems? Because they're not pure play streamers.
Well, certainly in Amazon's case, you know, Prime, everybody's now got some form of free shipping, Walmart, whoever. So they need other ways to keep people engaged in the Amazon platform. With Apple, it's also about this sort of universe. I mean, there's other places you can buy phones and that. And so having this prestige programming is also a way to have that connection with the consumer. And it sort of fits their overall kind of ethos. If you look at an Apple store, you really see that kind of working for them, the sort of elegant displays. You always see their devices in all their shows as well. It really dramatically stands out.
Yeah. All right. Chris Palmeri, our man out there in Hollywood, a closer look at the streaming businesses of Amazon and Apple. We do have some breaking news crossing the wire just a little while ago. I want to start with Ray Dalio, of course, the founder of Bridgewater. We have learned, according to the Wall Street Journal, that Ray Dalio has now sold his last remaining stake in Bridgewater Associates and has stepped off the board. Of course, this has been a long and, well, somewhat frustrating transition as Ray Dalio heads into retirement, and a lot of concerns here about the people left behind. The Wall Street Journal reporting that he has now sold off his last remaining stake and stepped off of the board. Speaking of the board, Wells Fargo has a new addition to the board. Charlie Scharf, the CEO of the company, will now be elevated to chairman. He will retain his CEO role, but he will now become a chairman. the company putting out a press release just a little while ago confirming that news. Stephen Black, who had been chairman, going to be stepping aside there. All right, as we wrap up our coverage here on The Close, we do want to set you up for what to watch over the next 24 hours, and that does include more earnings, including out of Exxon and Chevron. That comes before the bell tomorrow. You're also going to get that monthly jobs report here in the U.S. That's the July jobs report on the heels of that Fed meeting that just happened, and the quiet period for the Fed ends. Cleveland Fed President Beth Hammack is going to speak in an exclusive interview right here on Bloomberg. We're also going to get more economic data, including ISM manufacturing. And don't forget, tomorrow is August 1st, the start of a new month and the start of new tariffs, with the Trump-imposed tariff deadline now just hours away. This is Bloomberg.